Things are starting to change in markets around the world, but what does it mean when we take a look at the history of 2023 so far? Well, we know that retail traders and investors out there like you and I have been buying the dip. In fact, we've been doing it faster than almost ever before. But is this a helpful thing? Well, according to JP Morgan, inflows into the markets are at all-time highs for retail traders. At the same time, largest outflow of tech in 10 weeks has just been seen by the biggest traders. So what does this mean as the Federal Reserve cuts back on their overall asset purchasing in the big taper that's going on still in the back of the markets, and we have a close on the lows? Today, we uncover the secrets of the market so far. Let's get into it together. Well, welcome back everyone to the Daily Show where we talk about markets around the world, including stocks, commodities, and cryptos. We'll be covering the macro, leading indicators, and of course the hottest charts. But let's begin with the last 24 hours. What's been happening in markets? It was a clear sell-off throughout technology, and we just saw new lows with a close on the low. As we often talk about here on the channel, the close is the key. But what are some of the big stats coming out? As we mentioned at the start of this video, inflows and outflows are always important to watch from the biggest traders. We just saw record inflows, then we saw a massive sell-off from those inflows. So is that profit taking from some of the large funds? Well, according to our smart money, dumb money indicators, it would say yes. I mean, basically, we've got a huge discrepancy here between these two. Now, what smart money and dumb money inflows really tell you is basically when you get huge discrepancies between them, similar to other periods in time, such as what happened in February, and we can price up other things, it often tells us that we're in a swing trend change. And as of the last 24 hours, potentially we've seen a technical signal that tells us that there is more selling to come over the next couple of weeks. Now, what about some of the other things we've been sharing? Well, over here on Twitter, you can see we've shared some interesting information recently. We know that one of the big things was that JP Morgan reported that over 4.4 billion in equities was purchased in the previous week. That's a remarkable 2 standard deviations from the 12-month average. And over that period of time, Goldman Sachs actually told us that they were seeing net selling from the big funds. Again, that came through Goldman's Prime book, which I posted over here on Twitter. And if we go back over, I've got a new post here that's from the Wall Street Journal, which basically is telling us that buy the dip reflexes are pretty strong. 57% of all the options trades throughout the last 24 hours were calls. And this has been consistent now for basically around 3 to 4 weeks. If you went back a month ago, it would have been 57% puts, and every single time the market went down, puts would be purchased, not calls. We've flipped the switch on that one for sure. So what usually happens over these periods? Well, we've taken a look at the data, and as we know, we may go into a little bit of weakness here this week, but in general, we actually usually get what we call a summer rally. And over at the next 3 weeks, we've got to be careful of that. When we get sell-offs, we may still rally back through because the odds are, of course, in the favor of the bull. That's just data alone, though. So let's take a look at the macro together and then look at the technicals. The first macro I want to use is realistically this particular indicator coming out of JP Morgan. It's what they call the squeeze sentiment indicator. We saw a January squeeze. We've just reached it again. We had this during the GameStop saga of 2021. And of course, also the pandemic. And we know that we're now in the 99th percentile in terms of their squeeze indicator. What does that tell us? Everyone's too bullish, too much FOMO, and we're probably overly extended. We also know that ERP will become an important component of the Q3 earnings, which move forward through, of course, August and September. And that's going to be something that we will be looking at. Traditionally, one of the weakest periods of the year, even in pre-election years, and it usually brings the pullback that most people are trying to look for here, what we call mean reversion. Stick around if you're interested in knowing what that is. We'll check it out later on. Now, we know that calls are being purchased in their billions, and at the moment, we just saw a new all-time record only about 2 weeks ago of the most amount of calls ever purchased. We know also that put call ratios are starting to rise, and this was taken as a 2-week-old chart, so basically we'd be trading at one of the highest points ever. If you want to pause the video here and go back and have a look at what markets do around this period of time, I think you'll be surprised at how the S&P 500 ends up unfolding. Let's talk about investors as we go through here. Is it cheap to buy the market? I always like to look at forward PE and a bunch of other figures when we're looking at this. It's about 18.6 at the time of this recording. Is it cheap? No. Is it super expensive? Well, nowhere near the prices of 2021. So if you're a, let's call it any kind of partial value investor, then you're probably looking for a 16.8 or better. I like to get those 15 and a halves. That's one of my favorite levels. When we talk about sentiment in the markets, we know that every single retail trader flipped completely bullish about 3 weeks ago. So far, so good, but we've now unpacked around a week of that move from 2 weeks ago. And you can see here the sentiment is still incredibly bullish in this bull-bear spread. It's the most bullish it's been for a very, very long time. Here's an example of that bullishness, and you can see here 40% plus reads are bullish. Usually when we saw a read like this around 1 to 2 weeks later, we would see a sell. We ended up going 2 weeks, which was last week, and we started to see the sell. So will it continue? It's usually a fairly good indicator that we're in a significant turn towards mean reversion. If you're talking about recession, which I'm sure people will start to discuss again, just remember that when it comes to yield inversion, you usually don't see a recession until yield inversion goes back above the zero line. Just something to keep in mind if you're interested in following that. Now, why do I think this sell could be more than we're just looking at, and we could be looking for this mean reversion? One of the reasons is because some leveraged funds got smashed about a week ago. So when we look at the data, which came through from the OPEX week, so that was now literally about 10 days ago, what ended up happening was some leveraged funds got leveraged out. So effectively, they were forced to cover their positions, and that's, I think, a pretty big deal. It means someone lost big, and that means also probably a bunch of short sellers were forced to give up their positions. The market pushed them too far, it scared them, and then they had to pull it out. It's usually the way it seems to go, and we're seeing that on actually a massive scale in terms of net shorts actually reduced. Fear and greed index still sitting around the greed, no surprises there. As Warren Buffett would say, technically you want to be buying when others are fearful. At this point, it's pretty greedy, so some people may be looking at, of course, trimming up their positions. Let's go over to the wild world of options. So over the last 24 hours, I wouldn't say there was much options activity that was out of the ordinary. We did see some puts starting to appear on our weekend video. So far, so good, I guess, for those. They pushed through. And you can see here in the 90-day unusual activity, we had NVIDIA getting a little bit of action over the last 24 hours. And then, of course, we had some of the other main shows here. What I did find, though, was Snowflake and Zoom and PayPal are still getting relatively big trades across the board in comparison to where they were only a month or two ago. Now, if we scroll down here, you'll see 57% calls, 43% puts. That's again the reflex. Now, every single time we used to see a market drop off, it was all about the puts. This time, it's all about the calls. Everything's a buy the dip because we've been conditioned to believe so. And that's something that's very, very important. And of course, if you are an optimist in the markets, there's nothing wrong with that. It could be that we're going on to a very good time. But when you're buying short date calls, timing is everything, and having the right areas is everything as well. When we look at the 0 DTE options coming through for the SPY, you can see the top 3 were puts, and they were mostly puts across the board. Anything unusual here? Not really. We're generally looking for those longer date puts, and as we saw, we had a couple of them on the weekend for the main indices, specifically the SPY, and that might be coming to fruition at this point. If you remember rightly, a lot of those SPYs were triggering points at around 415. So 415, 410 was one of those big strikes that's now starting to come up. What about single stocks? Well, we saw Tesla trading pretty large calls and puts across the board. Whether they were covered or sold puts and calls, I'm not too sure. We'll have to have a look at that soon when we get the new software that we're going to be testing here on the channel so you guys can see it. And you can see also a bunch of NVIDIA, AMD, Apple, everything else. Anything unusual here? I wouldn't say so. It was all pretty much just fairly stock standard on the day. Let's move over to rotation. What's going on there? Well, we did have a little bit of rotation going through, and it was into some of the more hated sectors. We saw energy actually increase, and we saw, of course, some of the defensives, utilities hold up. Staples was barely down on the session. And unfortunately, poor healthcare, which has been doing pretty well recently, was down. Was it a full defensive rotation? I would say no, but it did have some of the most popular indices or popular sectors of the market, semiconductors, technology, consumer discretionary. they were all down the most on the session. When we take a look at a 5-day, you can see the big difference here on how the market's been sneakily kind of holding up healthcare and staples, and utilities is making a little bit of a comeback. Clean energy, solar, semis, and of course technology, they're the worst. Why? They're the ones that have the most extended charts outside of their Bollinger Bands and quite a few things. Speaking of technicals, let's jump on over here to one of the big technicals that we've been looking at recently, which is a combo of basically magma, although it's been put together wrong here. Microsoft, Apple, Meta, Google, and Amazon. Now, if we take a look at where that's at, you can see the 20 moving average, which is what we call mean reversion. We're still quite far away from that. Over the last 24 hours, did we get a shift in this market to say the swing is live? Well, not really, because we didn't actually see a new breach of demand. However, when we look at the S&P 500, when we look at the Qs very, very soon, so the NASDAQ, you'll see it's a little bit different. But just remember, these are the markets that have gone the most ballistic, so they have probably the most to fall to get back to mean reversion. From the top to the low here was about 15%, and there's still a lot more to go should we actually see that volatility come in. Speaking of volatility, while the VIX was up 6%, look at the volatility of the volatility, the VVIX. This has been the better chart to look at over the last couple of months, and it has shown us oftentimes when we're about to see some extreme volatility. If we go back over and you can see here the volatility of the 8th of March and how we spiked through, and also our lead in, as you can see here, the volatility leading into that 15th of Feb sell, that's the type of thing we're looking for, a spike up. It is going up at the moment as the markets are starting to sell off. That's a good sign, and of course it means that there could be a little bit more volatility to come. The skew has also helped us. We saw the skew crash. Then we had the data that said that the market should be weak after the OPEX, or the trillions of dollars of options expiration that happened only a few weeks ago. If you're not aware of that, you've got to subscribe. You need to make sure you pay attention to the options market at this stage. And we saw the skew crash. So that really just gave us the tick of approval to say if we start to see trend changes or anything like that in the small time frames, it may be worth day trades, etc. Put call ratio also gave us the tick of approval a few weeks ago. It said that there was a 1 to 2 week kind of pre-lead to a sell. So far, we've seen a little bit of a sell. And of course, that's what you usually expect. When it goes underneath these 0.7, 0.8 areas, you've got to be paying attention. Too many calls, not enough puts. Now, what was most surprising was really central bank liquidity. At the start of this video, we talked about that Fred result, which of course is the tapering of the central bankers out there and really removing a bunch of liquidity from the markets. But when you look at it underneath the hood, such as this particular indicator that we use here, what we found is that the Fed actually have been doing a lot of backdoor action. So while they've been tapering off, they've also been injecting a little bit in sneaky ways. Now, as we know, we have a market that's very extended away from basically what I would call the buyer of last resort, which is we know is the Fed. So when we're this red, this deep in terms of massive movement away, it usually means that we will mean revert at some point. And we've seen this a few times over the last couple of years, and this is the worst I've seen it in realistically 3 years. I've never seen it so extended away. If this green line continues to go down, which of course subscribe and watch this channel for that stuff, then what we'll be looking at is a market that could go even lower, and we'll be watching this one in particular. Following the Fed is very important at this stage, as we know. Demand destruction. Well, we don't see much stimulation from China at this point, and that's a problem in the markets, and copper hates it. It's hitting the supply. We pretty much saw the turn, further selling off. At this stage, there's no real copper support until we get into the 370s. And as many of you would know, this is called Dr. Copper to us. And the reason why is it shows us that metals and potentially energy in the future and everything like that is starting to look unhealthy. It shows us weakness in the economy. And usually the copper market is one of the ones to spot it first. When we go over to treasuries, they've been holding up okay. So the bonds market, yeah, it's been okay. If we go over here to the high yield junks, they weren't down in the last session. They were basically flat. So it wasn't much follow through from the high yield junks. Generally speaking, if you're seeing the stock market sell off, you want to see junks go down as well. And of course, that was not really happening over the last 24 hours. What about the US dollar? It's hovering around. I'd like to see the US dollar come back to around 102 and then find buyers. So around this area here is probably my interest level for the dollar at this stage, and it's kind of hovering in what I would call nowhere land at this point. It did have a nice strong move last week, which we suspected may happen around our interesting bull zone. But in general, it's hovering at a point where, I don't know, if you're long, cool, feel good about it, I guess. But I'd like to see it come back a little bit more to those areas we discussed. Gold has been very weak, and it makes sense. Each rally has been consistently met by sell demand. We talked about this in the previous video, so we won't go into it too much. But basically down here, we've got gold potential buyers. We still have that huge gap in efficiency down here as well. And the trend, at least for the swing at the moment, is down. So until we're proven otherwise, we still have to be kind of bearish on gold until we break through some of the key zones towards the upside, though it is in demand at this point if you're a scalper or a day trader. I've been looking at oil, but I do think oil is trapped within a zone. So natural gas has been the clear, better play in terms of the energy side. This particular market's been doing really, really well in recent weeks. We discussed how we thought this was bottoming just a while ago. We talked about the pullbacks to here and here is where we expected it to go. It hasn't swung the low. It's got a nice base on it, and no one cares about it anymore. So that usually is a good sign that it's probably coming in with that recovery. There was a stat we shared a while ago that was super bullish on natural gas over a 6 to 12 month period from that point. So are we finally starting to see the turn there? Well, percentages are good, but remember they call it the widowmaker. There are many risks in that particular style of trade, not just including the roll contract sizes. Let's move over to Tesla. Now, this actually changed trend over the last 24 hours. We saw a new low being formed, and markets came out, they hit the demand, they rallied forward, filling the gap here, which you can see was there, and then they just sold, and they ended up down 6%. So is it finally over? Is this the end of the rally for Tesla? Well, it's been doing really well. We moved underneath here, and you can see it's no close, but this is a long leg doji on the weekly, so obviously that's an indecision candle. It got the gap fill. I thought 300 might be possible as we kept just rallying, but at this stage, you can see here the turn has happened. You have to expect that in this point, basically rallies will be met by sell demand as long as the S&P 500 can continue down. So Tesla's kind of done a turn on the smallest timeframes. Is that, the best way of doing things? Well, if you're going to pick when you're looking at shorts, rallies now into the shorts are technically more live than they were at any other point through the last, especially $50, $60. Once we went past 195, it wasn't good. Where will the bulls most likely be? Well, I still think around 195 will be an interesting zone now, and it could be a bit of a brutal sell-off if we continue to see selling from the S&P 500. Let's talk about semiconductors. These are weakening. As we mentioned, we got into our supply zone. That was a fair trade if you wanted to play everything on average, but we have not moved below 143. So technically we are not on swing trades yet. We're not even close to our 130 kind of areas here from a bear target or a bull kind of area that you'd want to be looking at. So semis certainly looking weak on the charts. We go over to Apple. Apple's still holding so well. Absolutely no turn on this stock, though it did take a new all-time high over the last 24 hours, then sold off. We're looking for reactions around these levels down here. As you can see, that's the last low. To really change trends, generally that's what you're looking for, but also some smaller time frame traders will be looking for a little low underneath this area here, which sits around 185 on the charts. Yeah, Apple's been a tough one to trade. I usually don't like to short such strength here, but it is one. Now, in notables, there were so much more selling in things like Google. I mean, Google looks terrible. We've got that head and shoulders style pattern. It's been one of the weaker of the big tech stocks. It still looks really weak. And if we go and put it on a chart, it also had a 61.8 retracement from the high all the way down to the low. So really, if you're going to see swing turn changes, this is it. Make of it what you will, but you can see here the way it's set up. And the same thing was going on from Meta and a few other stocks. Let's move over to defensives. Did they find buyers? As we mentioned, we saw buying in utilities, staples, not so much healthcare the last 24 hours. Again, nice little bullish hammer. If the markets still suffer, or even if they go up and we see staples start to outperform again, it's a good sign that that rally will be faded. So we're really looking at the rotation at the moment in the markets. If they keep buying defensives on a rally, more so than they're buying some of the other stocks, we need to pay attention to what's underneath the hood. Let's go over to the markets now. We'll talk about indices around the world. First up is the Eurozone, the DAX here. Wow, it is so strong. I don't want to short the DAX at all. Even though it's on an all-time high, just no change of trend. Look, if you're going to do a trade like up here, you're obviously getting a very tight stop loss. You're going to lose it a lot of the time, probably only win 30% of the time. So you need to make it pay off pretty large. Is it a point where you could do it? It's an all-time high. I guess you could make your own decisions there. Let's move over to the XJR. I've been very weak on this market. This is the Australian market. And what happens here is you get a lot of demand destruction plays. We have energy, we have financials, and we basically have metals. And that's a breakdown of the Australian market in one. Now, there are obviously other stocks outside of that, but that's predominantly what makes up the top 200. And you can see here the weakness. I'm looking for the XJO to continue its weakness down into the 69.50 kind of area. So that's something we're looking for here. US 2000 was weak over the last 24 hours. It rallied, then it sold. Again, the rally wasn't, I would say, very strong. It's kind of done a little change of trend. I could see buyers maybe trying to recommit here over the next 24 hours. Not a strong play, though. I usually like to target these kind of areas, and I would call it in the middle of limbo land at the moment. But certainly it's been weakening, and I'd like to see it back in those levels. The Qs sold off to the close. Look at that, right on the low. Now, generally speaking, and it didn't happen last time, when you sell into the close, you usually get follow-throughs. And of course, there's been a few times now that hasn't necessarily happened. It's a statistical fact that you generally do see that, especially when you break a key range. And when we took out that 360 on the Q, that was a fairly significant level. Let's have a look at it on the NASDAQ here, and we'll scroll into a 2-hour just to show the key zone that we broke through. So here it is here, and you can see that there's that nice level of support, and then all of a sudden the market went straight through it. And at this stage, rallies are going to be, you would think, met by sell demand unless you get through these key levels such as 15,200. Look at that, right into the low point. It points towards certain issues such as this over here being filled over the next couple of days. What do you think in the comments down below? Do you think this is the NASDAQ and the S&P gearing up for a bit of mean reversion back to the 20 moving average? Let me know. Let's have a look at the SPX, another close on its low. We talked about the Bollinger. Do not discount the Bollinger during these periods. We've seen some where they've gone an extra week, but then they usually fall over. It is no joke. We usually go sideways to down, up. Obviously, breakouts are super massive here on the Bollinger, and it happened. So now what we tend to see after this point is the market usually stagnates and often goes towards mean reversion. Now, that would be the weekly 20 you'd be looking at. So it sits around 41.50 at this point, back in that structure. Is it possible? I guess it is. Let's have a look at ES. Volume, a bunch of volume indicators in general, quite weak here again, showing that this sell-off is, I would say, not necessarily seeing the usual volume you would get. And that's because I think it's, summer, obviously, in the US, and we do tend to see a slowdown in volume. But we've got the sell here at this stage. Let's have a look at it on the futures market here. It did get underneath that 43.37. So, yeah, it broke underneath. Yes, it closed. Yes, it hit the daily 20 moving average pretty much, which is right in the middle of the Bollinger here. So are we going to see buyers? I wouldn't be surprised at all to see a little bit of a knee-jerk reaction up. But at this point, that is still a break below. So for bulls, you want that thing above 43.70 on all circumstances. For bears, you want to see everything get faded before that point and keep pushing down into our next structural zones. 4,300, 4,260 key on our charts here to find whether there's bulls or not at those levels. And then, of course, past that point, we're looking at around a 41.50, the most traded zone for a very, very long time. So the S&P actually put in a fairly interesting low here, rallies, all sorts of things. We've got some great key levels now for markets. And yeah, as we mentioned, this is a fairly significant change. We've got a daily close underneath those lows. That usually means that rallies will be met by sell demand over some period of time. Let's take a look now at Bitcoin. What's going on in the Bitcoin world? Well, it closed right on our 30,500, which kind of sucks. Because that basically means that we don't necessarily have a super bull pattern for it. Bitcoin has been very strong. You can see here it's been consolidating around these highs for For bears, you want to see it underneath that wick there. So let's have a look at that on the 2 hour and we'll check it out here. You can see you'd want to see it underneath 29,500 if you're a bear. And then you're probably looking for rallies to be met by sell demand. That's pretty likely if that did happen. And for bulls, you just need a new high. I mean, basically, it's going to be explosive. At the moment, you'd have to be leaning towards the bull side than the bear side. That weekly still did close around the right levels. And we also know that Bitcoin versus things like the NASDAQ, Bitcoin versus ETH, even the timing of the market, it's very behind where it should be at these points. Think back to 2020. We had 2020, then we had March, we had a bit of a rally. Then by December of that year, we were going ballistic. If we consider October the base, well, you can do the math on it. I'll do it in the next video, so definitely check that out. For the news for the week ahead, let's have a look here what we've got going on. It's not too much. Obviously, we have some US news. We do have Fed Chair Powell speaking on Wednesday at 9:30 a.m., which is going to be important. Final GDP numbers, usually doesn't move the market. And then if we scroll down, we've got one important thing that the Fed likes to look at, which is core PCE price index, which is Friday at 8:30 a.m. Do remember the week after is going to be non-farms as well. If you enjoyed today's video and you're interested in some of the other things that we offer, we do have a free competition at the moment for June. Links in the description and pinned message down below. So definitely check that out and make sure you enter it. What do you got to lose? You literally get free stuff if you win. And you can maybe even be talking to me in July's 2023 group mentoring. Thanks so much, everybody, for watching the video. If you enjoyed, subscribe, smash the like button. We'll see you in the next one. Bye for now.